All right, welcome back, guys. Let's get right into it. I'm just going to go right into the charts. Give me a thumbs up if you like the content. Let's get going. So the reason why I want to get this video out relatively quickly is that we had a kickback rally today in the triple Qs. And here's what I'm looking at. All right, I've got this bearish rising wedge. And the upper line is, I've been kind of tweaking it a little bit. I've had it here, but we could also put it right here, okay? Because you had a reaction here, and then you also just had a reaction here, and now we're having this kickback. But again, I need more than 2 data points to say something is a confirmed trend line. And so the bottom side of the wedge looks good. I've got, reactions down here, here, and here. And on the upper end, you've either got it here where you have multiple reactions, 1, 2, 3, and then we're just overshooting that, or you've got it here and I've only got 2. So it's hard to say, but ultimately, you got to give it a little bit of room with this market. You can't just say that, oh, the wedge is broken. If I leave the trend line right here, then we broke to the upside, but it's not impulsive. And so that tells me it's not a confirmed breakout. And then on the horizontal resistance, we've got resistance right here at 214.50. And as you can see, several reactions. It goes back to here, but look, you can see it held as resistance there, and then it acted as support right there, and then again acted as support right here, right there, and then gap down. It held as resistance. So several reactions around that level. So that's right where we traded up to as of right now. So I just added to my short position right there, and I think this is probably the end of the bear market rally. It's hard to say because obviously we don't have any, there's no gap down or anything, but I think that's the end. I really do think that's the end of it. So I want to get this video out quickly on that. And let's look at my 1 minute chart real quick. Here's the 1 minute, and I've marked that line out right here, 214. Really just marking kind of the high, but I know it's right in this range where resistance should play out. So we'll see if it wants to, maybe it sells off today, or maybe there's a gap down. I mean, the gap down would be the trap. And that's usually what you're going to want to see when you end a bear market rally. You need to trap that money in. And so you're either going to have really impulsive selling intraday that happens really quickly, or you're going to have a gap down that traps that money. So could go either way. And I don't know, maybe they close this thing bullish, everybody feels great, and then they gap it down tomorrow. I don't know. We're at resistance, and if the bear market rally is going to fail, it should do it in this area. Doesn't mean it has to be right here. Could be $1 higher, could be, $2 higher. It just should be in this area where the rally should fail. So I feel pretty good about adding to the short position here. Low risk. I mean, if we continue to go much higher, then we're probably not in a bear market, to be honest, and we're probably going to rally on to new highs. So at that point, I would cover my short. So adding to the short right here, I don't have to go much further in order to realize that I'm wrong. And this is an objective area to add. So that's why I'm doing it. I expect to see some sort of impulsive selling or a gap down. That's what I'm looking for. All right, so I'm going to try to get this video out on that topic. And then we can look at some other charts here. Let's look at XLV. This thing looks just ripe for a bear market. And it just looks great for a bearish rising wedge. So it's still just within this wedge, nice clean wedge. We have divergence on the RSI. It's just set up perfectly for a breakdown, and they're probably not going to do it intraday. It's probably going to come in the form of a gap down. That would be just the trap. Maybe it gaps all the way down to this 93 range right here. Something to trap the money in. And so I'll be looking. I am short this right now. I'm just trying to anticipate the breakdown. I just don't see a lot of risk reward. If it gaps up, then we'll just cover the position and take a small loss. But again, I entered this position right here at 97.50. So I'm just underwater by 40 cents or 50 cents or whatever. But I think we're going to get some sort of break to the downside. That's what this pattern tells me is going to happen. So whether it does, I don't know, but the probability is set up for that to happen. Let's look at these fangs. The Qs has been going up because Amazon is basically gone parabolic. And so this is a FOMO trade right here. I never take these. I never jump on these. In fact, usually I look to fade these things. I'm not looking to fade Amazon. It's just not something that I'm really looking. I'll play this fade in a different way. I'd rather play it with a diversified index or maybe some sort of other tech play. But this is the FOMO trade, and these almost always end with prices moving in the opposite direction. So I never chase these kind of moves. My trading style is I typically look to anticipate these moves. So I'll enter these positions before this move happens, anticipating that move, and then when that move happens, I sell into that. So I like to buy into weakness, sell into strength. And that's typically, how I'll start a position. I will add to a position if it's a strong position. If I already have a starting position, I can add to it. But I never will just jump on and take a new position on a FOMO move. It's just not my style, and I typically look to take the other side on that. Microsoft. Bearish rising wedge as well. I've marked this one out. Again, we only have 2 data points. We could call this one a third one right here if we get some sort of reaction. It looks like we're getting a sell-off. So if selling comes in right here, then that's our bearish rising wedge. We have 3 reactions on the bottom, and we also have resistance. And look, we got this gap right here. Here's your island cluster. So we fill the gap at 177.26. So we're close. I'm actually really surprised that the market gave this stock gave traders an opportunity to get out of their long position on nearly a gap fill here. So usually you don't see that, but at least not not for a while. But at the same time, the Fed has come in, and they're trying to probably give people an opportunity to get out. Anyways, so I think Microsoft sells off here. That's what the chart tells me. Apple, I'm short Apple. It's just trading around. It's I'm down slightly, but not a whole lot. And it's just chopping around this trend line right here, which is this black line that I have marked out. That's your that's your bull market trend line for the decade-long bull market in Apple, going back to 2009. But it's gotten pretty sloppy recently. This trend line was intact for many years, all the way up to 2018, so 8-9 years, and then it broke. And then recently, it's just gotten really sloppy. Where we broke, we back tested, we came back and broke back above. Then we failed. Now we're back testing again. This line is losing its importance because it's just it's getting. It's not holding, I guess. It's breaking to the upside. It's breaking to the downside. It's not holding as support and resistance as much as it should. So that we'll probably be looking for a new pattern here soon. But until then, I'm going to treat this as, kind of the top of this bear market rally. We broke above. This is where they're maybe running some stops here, and then they're going to fail. And probably at least come down to 261 and then most likely break. This trend line, if I mark it out, something like that. So I think Apple's going to head lower, and look at XOM. XOM's acting. There's a lot of signs that tell me that this is a bear market rally. For one, oil is selling off. Here's your bearish rising wedge in oil, or XOM, I guess. But I'm sure we could see the same thing in USO. But bearish rising wedge. We broke, we back tested. See the back test right here? This is the things you want to look for. So, and this is an hourly chart, but we broke, not an impulsive break, so nobody believed it. So, but then it just traded sideways, couldn't recover, tried to recover, only did a back test, didn't even get there, and then failed, and then you get the gap down. So that's like the trap basically, because you can see it just traded sideways throughout, and then trapped the money by gapping down, and then start to move lower. So this is bearish. This is starting to move lower. Now we could easily do another back test, but you already had one, so I think this heads lower. And And if oil's not going to act nice, the market's probably not going to act nice. And at the same time, if you look at the financials, let me pull up the financials here. I don't actually have a financial chart. Oh, and on the side note, I cut this Walmart one yesterday. Actually, I cut Costco as well. I cut it earlier today. Costco and Walmart. The trades that people are thinking are benefiting from the coronavirus shutdown are still performing basically, and so I cut this. It just wasn't acting right. I didn't like how it gapped up today and was trading right up in here, and I just didn't like that above my trend line, so I cut it. Took a small loss there. Again, the name of the game is risk management. If you're not going to have all winners, but if you're able to analyze your losers and realize, okay, this isn't really working. It's not doing what I thought it was going to do. Let's get out with a small loss, live to fight another battle, and look for something different. That's how you preserve capital. If you ride winners out, just not willing to take small losses, that's a lot of things new traders aren't good at. A lot of people, when they first started trading, myself included, when I first started, I had a hard time taking a loss. I wasn't able to let that position go at a loss. I wanted that thing to be a winner, and I continued to trade that way. But when you realize that when you cut those losses short and you let your winners, you really press your winners, you end up making money in general, and it doesn't. And then you don't feel as bad when you let the losers go, because you're still making money in your account, and that's kind of how. That's just a skill you have to develop over time. But again, I would suggest when you see something that doesn't work, give it a little wiggle room. You want to make sure it's confirming on whatever chart that you're looking at, and you're not just getting a fake out move. When something goes against me, I look for the fake out move. Is this just a stop rate? Is this some sort of trick where they're going to gap down tomorrow? You always want to look at that. But then if it just does not continue to look like it is going to be a fake out move, and continues to go against you, you cut that. I cut that position. All right, and I got to get this video out really quick because the Qs is starting to sell off. So we will have to come back to the financials. But if you look at the XLF, JP Morgan, all the banks, they are selling off and they are breaking down. Looks like they're going to continue the sell off. And you don't expect the rest of the market to go up without the financials. So I'm going to get this video out, let everyone just kind of watch this and make a play. And again, it's really hard for me to get the video out when right at the exact levels. But if you look, here's the top. We're starting to break down. So I'm going to get it out. Thanks, guys. Give me a thumbs up if you find value. Bye.